Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Scrolling through the comment section, like to answer some of your guys' comments and questions in the comment section. It says, so when you say you only hold physical precious metals, does that mean no miners? Or because miners actually have no? So what I mean by that is I don't own ETFs that represent physical metals. I actually own the physical precious metal. And why would I do that? Because basically you're just back to the same game that we're in with our currencies. Currencies used to be a representation of physical metals where you could exchange that currency for the real thing. The currency, the piece of paper was a claim to the physical. Now, what's an ETF? If you can't redeem your ETF for physical metals, and the majority can't, what's the point of buying it? If you can't redeem it, you're just holding a certificate of nothing if you can't redeem it. Now, even Sprott in those physical trusts, you have to have a good amount in there to be able to redeem for physical. So what's the point of investing in the physical precious metal if you can never get the physical precious metal? Like, that doesn't make any sense to me. It's like buying Bitcoin or any of these cryptocurrencies. They don't make any sense. They don't have any value. They are valueless. Now, just to sidetrack on that, I agree that we need a free market money system. 100% agree with it. That's what gold and silver is. That has been for thousands of years our free market money. Now, the cryptos, I don't know what they are. They are horrible networks that aren't that great, that fail to be great. It's just the idea has validity to it. The idea, the actual reality is, I think, falls short of what we need in order to get to a viable, you can call it decentralized currency. It's just the best thing that we have. It's the closest thing, but it doesn't actually work very well. I think they're all going to fail, but that's me. And speaking of mining companies, if you noticed in all my videos, if you've been on the channel for a little while, this is what I'll basically parrot is when I have the gold and silver companies, I have some mutual funds in my 401k that are precious metal mutual funds, a big diversified basket. I have royalty companies. Royalty companies are diversified baskets of precious metal representations. They have royalties on it. And then I don't have many mining companies. I don't have a substantial net worth in mining companies. When I first had the channel, people kept asking me about platinum. What are the platinum miners? What should I get in? What should I get? And they kept like harping on me for leverage to the platinum move. And I kept saying, buy physical, buy physical, buy physical. It's by far the least risk way. And the reason I kept saying this and why I don't have a ton of mining companies, I do have mining companies, is they carry a ton of risk. And a lot of that risk isn't worth the extra reward that you're going to get with it. And I'm only talking about some of these mining companies. Gold and silver, they have a ton of mining companies. They're all over the place. So I have some money in like EXK, AG, Hecla Mining. I do have a little bit in Fortuna Silver that got hit too. And that's the reason I don't own a ton of them. Like, I don't have a bulk of my portfolio in them because they have such higher risk. And the rewards, I mean, they're hopefully, I'm hoping that they're going to have really good leverage to the price move. Sometimes they don't. And that's your risk. That's why I kept saying, buy the physical, buy physical. Like, physical is the least risk way by far, bar none. Like, your risk is nothing in comparison to these mining companies, especially if they only have a mine or two. Because what happens, I'll go through a scenario here, all right? You invest in these mining companies. Let's say gold and silver take off. Absolutely rip it. They go to $10,000 gold, and we get to, I don't know, a few $100 silver, something like that. All right? And some of these companies absolutely kill it. What do you think these money-hungry governments are going to do? They're gonna try to tax the living heck out of them. They're gonna nationalize things. They're gonna do stupid things. I mean, governments are really stupid. That's just an overall statement, and it's true. And they're going to try to get all their money that they can. They're going to try to tax the living heck out of it. They're going to say that these people are bad or whatever. And if you own the physical, you kind of bypass all of the junk. And that's why I held a substantial amount of my net worth in physical metals, and I continue to buy physical metals. I prefer them over the mining companies by a long shot. Now, some of these mining companies, they're going to return incredible amounts. That is true. And I'm trying to find which ones. So the way that I do it is I diversify my holdings out, and I own a lot of them. I don't own a huge amount in any single one of them because of that risk. Now, in uranium, it's different because there's not many companies, we'll call it mining companies, that you can really diversify across. So if the money comes into that sector, it's going to hit on these few companies. So you don't have this like 2,000 gold and silver companies all over the place scattered, where I have to really look and research very much into. Uranium's all concentrated. So that one's a very good sector because of the concentrations of companies. And there's not that many companies. Oil, I went into a lot of those oil companies that they have, a couple of different fields. They're somewhat diversified. I went mainly into the United States and Canada. And then I have very few outside of that, just because of the jurisdictional risk. And I know those companies will move with the price of the underlying commodity. A lot of these gold and silver ones, they're all over the place. So I prefer the royalty companies. I've said this a lot over the channel. And what you guys are probably going to realize is that some of these companies, even in copper, I don't own that many copper mining companies. I've been going into Nova Royalty. Why am I doing that? It's a diversified approach. They've got a whole bunch of different mines. Their counterparty risk of the larger companies, and that's what I own. Then I own a bunch in the diversified mining companies that are very large companies. I don't own a lot in small mining copper stocks. I don't own a lot in small mining gold and silver stocks. I don't own a bunch. I've got huge physical holdings, a good portion in mutual fund and royalty companies. And then I've got a whole bunch sprinkled across, I'll say smaller royalties. They're not huge holdings. They're just, a decent, okay amount in the smaller royalties. And then I've got small amounts I basically focused on silver mining companies. I don't own any gold mining companies. I own very small amounts in exploration gold mining companies. And when I'm talking about small amounts, I'm talking like 0.2% of my net worth or less, 0.1%, 0.2%, very small amounts. And if they go up some hundreds or thousands of percents, perfect. But some of them I'm going to lose on. I've lost my butt on a couple of them, 70% down. That's why I spread out. Now, if you guys are if you think that you're trying to get a bunch of mining companies, these small ones, like I won't name any particular names, but let's just say ones that are starting up a single mine. Like, there's a lot of risk there. So just be careful. I don't own a lot. I don't put a lot of my net worth in it. It's very small amounts. And you can have guys that are, billionaires telling you that they're good companies, but those guys are spread across a ton of different companies. They put a bunch in a whole bunch of different companies. And remember, it's not just the risks internal to the company. There's a bunch of external risks. What about an energy crisis? How's that going to impact the company? So I'm very much physical, and I'm not saying I'm 100%. I'm not, but remember, my breakdown is, if I could do if you can do, I'll put in the description link below the swapping metals game. Watch that video of physical precious metal swapping. You can go to dealers. You have to talk to the dealer. Ask them what the exchange rate, if you're going to hand in your metals, what they're going to pay you. And if you're going to do it through private parties, you may have to go to Craigslist and sell it on there and then use that money to buy other metals. But you can exchange metals with some of these dealers. Some dealers, all they want to deal with is gold and silver. So you're going to have to find someone else that will deal in something else if you want to include the platinum group metals. I mean, I have a dealer here that will do anything because he'll call a larger hub, and that's who I deal with. And then I bring in my copious amounts when I switch. And I don't swap it very often. We're talking once every few years at the most. So I wanted to go over that. It says, other than royalties, I might sell out of most of my stocks once I get back to my cost basis and go almost 100% physical, 70% physical now. I think input and energy costs will eat their lunch, or we could have a dollar collapse and superinflation sooner rather than later. And we very well could. And that's a very good strategy. And I'm going to say this, with the swapping game, I'll put it in the description below. If you can swap metals, it's a super low risk way to make a lot of money. You know the commodity is going to track the commodity price. And people are going to say, well, what about the premium? Okay, what about the risk you're taking on buying the mining companies? I would rather pay a small premium and you can handle that premium. Find individuals to buy from. If you know what to look for, then buy one from a reputable area, buy a couple of different bars or coins or whatever, get it in your hands, look at it, and then compare it when you go to buy something else. Don't buy stuff that is, we'll call it, that you don't recognize. Don't buy that metal. Buy stuff that you recognize. Buy stuff that's government issued, sovereign coins. Buy bars that like Pamp Swiss or Valcambi or whatever it is. And honestly, you don't have to take all the risk in the world to make a lot of money. A lot. You could stick with the physical game and make a lot of money and be protected against inflation and deflation. Why do you think I'm a perfect portfolio mix could be 33% physical metals, 33% real estate, 33% equities. Now, the equity people, if you talk to an equity financial advisor, he's going to say that's garbage. You should be more in equities. Well, yeah, it's because that's what he sells. He sells equities. That's where he makes his money. Of course, he's going to want you to be more in equities. But I think a very good portfolio is 33% physical metals, 33% real estate, and 33% equities. And if your equity side gets larger, buy more physical metal. The game here is to get out of this system, really, to protect your wealth against these governments. They're all going bankrupt. Why do you think they're printing so much money? They're bankrupt. They're done. We're at the end of probably a credit cycle that's going to have high inflation. I don't know if it's going to be hyperinflation, but we're going to have high rates of inflation. So that's my take on it. And so what's the bear case? It says, I think we're going to the moon, but if we take our heads out of the clouds, what would be some signs that aren't panning out? Well, you're going to see it in your housing starts declining. You're going to see inventory of real estate go back up, because what happens is if you have a real estate crash, that's your deflationary collapse. Your credit deleverages. Everything else is basically worthless to really look at. I mean, there's a couple other things. The 10-year yield going down means people are running into bonds, that you have a problem. The banks will know. The banks are the ones that do all the lending. They're going to look at it and say, okay, this lending's garbage. We have problems in lending, or our lending's contracting, or the real estate markets, we're getting a bunch of foreclosures back. So what they do is they're going to invest their money a certain way. They're going to say, this is garbage, it's going to collapse. And then they go run into bonds and drive yields lower, because all this demand for bonds goes up, which means yields go down. Your copper to gold ratio also tracks the 10-year yield, so that's going to decline. People are going to prefer to buy gold over copper. If your economy's strong, copper usually goes up at a faster pace than gold, so your copper to ratio goes up, which the copper to gold ratio is going up. So our signals right now are all screaming that we have inflation coming and that we should be in commodities and precious metals. Precious metals will go up as well, but copper will just go up at a faster pace. That's the economy wanting to suck out copper. So, and then other areas of the world, like you mentioned, housing inventory. The USA is the big one because that is what commodities are priced in. They're priced in dollars. So that's why I look at the dollar. China, they may have problems in their housing market, but I mean, it's I don't know what of an impact. You'd have to look at the 10-year yield. You'd have to look at copper price and all that other stuff. If they're having a huge blowout crash that impacts copper, we should see the copper price fall, the copper to gold ratio fall. You should see 10-year yields fall. If you don't see those fall, then it doesn't have an impact. That's kind of how I look at it. And if you can piece this stuff together quite well, you'll be protected. That's what you're relying on are your leading indicators. So, and remember, the mining companies, a lot more risk. Physical, and there was a comment on here that wanted me to go through kind of how did I lose? How have I lost a lot of money? How have I lost a ton of money? And I'll be honest, I haven't really lost a ton of money in any one go. Why? Because I never subjected my amount of money to a risk that great. I have had 70, 80% declines in companies, mining companies that have lost their license, mining companies that have problems with their permits and stuff. But I never had a large amount of money in it. So it never really had a blowout crash to the portfolio. I have had big pullbacks like the event that we had in 2020, where my portfolio got hit pretty hard. But I didn't do anything. I stayed in it. The losses never materialized. They were only a fictitious number on a screen, and they all came back quite dramatically. And I made a lot of money because I piled in even more money at the bottom, piled into physical metals, piled into all this stuff. And be careful who you guys listen to. I mean, on YouTube, I'm getting a lot of comments too about like David Hunter. Okay, this guy, he doesn't know what the heck he's talking about. I'm not saying that I do, but there's no signaling what he's trying to say. A lot of these guys, I'll go into this here. A lot of these guys, Peter Schiff's been saying $5,000 gold since 2009, the entire time. Harry Dent's been calling for a crash the entire time since like 2010, 2011, like every year. There's going to be this huge crash, huge crash, huge crash. It never comes. Why? Because the real estate market's not going to crash. That's where your deleveraging comes from. And you can't predict when that's going to happen. You have to see it in the data. You have to see the inventory blow up. It's not. We're at low inventories. It's not going to crash. I'm sorry. Now, the event that we had in 2020, that crash, that was man-made. That was not, and you could see it in the declining copper to gold ratio. You could see it in the 10-year yield. Thing is, they shut it down. They did it on purpose, and people ran into those. They ran into bonds. You could see it. The yields dove right before it happened, and then we sold off. But I just rode through it. I said the valuations are good. I'm going to ride through it, and I did buy some at the bottom, and I did buy a bunch of physical metals and did some swaps and all that stuff into from gold into platinum and palladium into platinum and stuff. But a lot of these guys, they don't take what they say at face value. And even myself, don't take what I say at face value. Form your own opinions. Form your own thesis. Do what works for you. But a lot of these, I'm starting to see all these clips on deflation, technology being deflationary. Guys, these people don't know what they're talking about. There's no way. They are so misguided, guys. Oh my God. Like if they say that deflation comes from technology, just honestly shut off their video. Monetary deflation. We're talking about monetary. Prices going down is not deflation. That it is so, they are so messed up in their definitions almost that it makes me feel at a loss of words. Like I feel almost like sad for you guys. Because these guys have no idea what they're talking about. I'm not trying to say that I necessarily know everything, and I don't. But you got to get your definitions right. Inflation and deflation. Now, the way that they have changed it over time, I disagree with that definition. So the old definition, and Peter Schiff has this right, and some of these other guys, they have it right. The definition is just an expansion of money. The expansion of money comes from an expansion phase of real estate. It's a credit expansion. Now, right now, they're playing with the money supply. They are pumping money through the system like no other. We have not seen this before. The money supply, the M2 money supply, is increasing. And I'll pull something up here. It's on long-term trends. Yes. So this is long-term trends. If you look at the M2 money supply and inflation, I'm going to show you something here. Here we go. It's loading. This is what's happening. Here's your long-term in the black line there that you see in the back. That's your M2 money supply, the black line. Look on the right-hand side. Look what they did. That's the M2 money supply right here. This black line coming up. They went up 25% in M2 money supply growth. This red line, which is inflation, is lagged behind the M2 money supply. It's going to follow this line upward. We're going to see massive inflation over time. And they're still printing at like 13% or 13% here of M2 growth. This inflation line's lagged behind it by like 1 to 2 years. It's going to rocket higher here and follow this line. And it's just starting. This here it's going to be inflationary. And these guys are smoking crack who are going to say technology is deflationary. I'm sorry. They have no idea. There are very few people online that I actually watch and trust. That M2 money supply is going to convert into inflation. And it's coming right now. We're going to see a wall of inflation coming right now. Why do you think gold and silver are starting to move? People are starting to figure this out. They're getting afraid. They're rolling in. Oil's already taken off. It's gone. That's like the first thing that happens. Money supply goes up. Oil reacts the fastest. It's the most sensitive to inflation. This stuff's going to penetrate and go all through these different sectors. Next year is going to be a tough year. It's coming right now. That M2 money supply is going to be converted into inflation, and we're going to see high inflation rates, 10, 20%. It's going to convert into it. It's going to be 6% plus inflation. We're going to have massive real negative rates. People are going to sell their bonds, and they're going to go into probably precious metals, and we're starting to see that right now. We can see it in the charts. That is your verification. Now, I'm talking about people who I would trust on the internet. If you guys want to watch some people, go look at Market Sniper, Francis Hunt. That guy does a very similar approach to me. And what he does is he looks at data through charts. And then you draw conclusions from that data. That's the same thing that I would do. Just like we're looking at the data behind me. Now, for someone to say that we're going to have this big deflationary crash, what are they going to? What's their response to this M2 money supply? That thing went up over 20%. It's just lagged. I mean, look at the correlation, guys, in this chart behind me. All right? M2 money supply rocketed higher in 1943. And then in 47, it was delayed some years, but it came raging forward. And the inflation rate is usually just lagged behind the M2 money supply. So we came up here, we had high M2 growth at 13% in the early 70s. And then in 74, it was 12%. So it's roughly the same amount. And you can just see this cycle. It's a few years delayed behind it, the M2 money supply. Look what we did over here in this massive money creation, sending everyone checks scenario. Now, here's something. We've got all these supply chain problems, right? They're all over the place. Shortages, chip shortages, this shortage, this shortage. Why do we have it? It's because they increased the money supply by 20% and then sent checks everywhere. Of course, you just increase the demand for everything by 20, 30%. The supply chains can't keep up that fast. Of course, there's going to be shortages of everything. It's because your money supply, the supply of money rocketed higher. Technology can be deflationary, or I should say technology can lower prices. But your inflation and deflation comes from the M2 money supply. That money goes somewhere. It goes into crypto, it goes into stocks, it blows something up. How do we know it blows something up? Through our ratios. Our ratios will show us this is expensive to everything else compared to history. The money went there. It's that simple. You don't have to do predictions. You just look at it. And then you see how the ratios are interacting with each other. Is one starting to bottom and turn back up? Well, that's going to be a trend. Invest in the trend. That's all you can do. As an investor, that is all you can do. Is invest in what's trending into favorability. How money's starting to rotate and flow from sector to other sector. Stocks don't go up because of fundamental analysis. In my opinion, fundamental analysis, and I've got some comments on this. How come we're not doing our due diligence? How come we're not going in the fundamentals? The fundamentals don't move companies overall. Money flows do. And to understand what's coming, that inflation's coming right behind us. The price moves in oil are going to be so fast and great that, in my opinion, that people are going to be like, what the heck just happened? How are we at $150 oil? How are we at $200 oil in a year? That's what I think is potentially going to happen. I agree with some of these other guys' analysis, like the market sniper. That guy's he's the reason I think he is pretty good. That Francis Hunt guy, our alignment of how I look at things and how he looks at things are very close. And you have to have this alignment. You can't just make things up. You can't say, I project. Projections are very difficult. You look at trends. You look at what the market is telling you and the signals from the market. The only way that you can see those signals is through technical analysis. That's what you're going to, if you look at this stuff for many years, fundamentals, if you look at just fundamentals, it won't give you timing necessarily. Market balances and inventories are a way to look at the market in its free state, so to speak. Like it's you have an interaction between buyers and sellers. They're interacting with each other, and the inventory is the byproduct of that interaction. That makes sense. So if you look at only inventories, you could probably tell the health of a market just by looking at inventories. And inventories only. You don't have to look at the growth rate of the inventory. Just look at the rate and compare it to history. That's all you have to do. It's that simple. So when you look at the M2 money supply, the M2 money supply is nothing more than an inventory of money. It's how much money is in the system. It's just an inventory. We've got X amount of money in the system. Oh, well, the money supply went up 20%. Oh, that's going to increase inflation. Done. It's that easy. It's nothing harder than that. Then you just look at some leading indicators. The 10-year yield. What are people doing? Oh, the 10-year yield's going higher. They're worried about that. If money's flowing out of bonds, they're worried about inflation. That is a logical conclusion. These guys that are saying that a crash is coming, well, no one else believes them. Otherwise, your 10-year yield would be diving down. So I get a little bit. I get a lot of comments in the comment section about like these people worrying about deflation, and it's like, guys, this is not going to be deflationary. Just watch yields, 10-year yields. They are moving higher, and they're trying. What are they doing with QE? They're trying to hold them down. They're buying bonds. We have inflation if they're in there buying bonds. They're actively suppressing interest rates to hold certain market areas up. Now, housing, we have no inventory. That's the real estate. We'll call it the health of the real estate market is that we have a massive shortage of real estate. We have no inventory. Rent prices are going up. So if you have no inventory, house prices go up first. Second is rent prices. So these guys that are using house prices to rent, like that ratio, well, yeah, it's gonna first go up, and then it will stabilize. I mean, a lot of these guys, they have no idea what they're doing by looking at the data, and that's dangerous. And I'm referring to some of these people on YouTube. And we have seasonality mixed in there. It's this big soup. Seasonality, we're going to come back down in house prices. We're coming into the soft part of the year. Of course they're going to come back down. I mean, it's nothing too big, and inventories may go up some. We may trend towards a more, we'll call it a more of a buyer's market than a seller's market. It has to at some point, because we're at record low inventories. At some point that has to happen, but I don't think it's going to happen very soon. We have to build a whole bunch more new homes. That's your housing starts. And if your housing starts have to go up because the inventory is too low, that's an expansionary phase of real estate. You don't have a crash coming if that were to happen. No crash. That's my opinion there. So be careful who you listen to. Be careful on all of the risk that you guys are taking in some of these mining companies. Be careful. Remember, I'm big in the physical metals. Why? Because I know they'll move. And I like the royalty companies because they're nothing more than a diversified stream of income. That's it. That's all it is. That thing's coming behind me. This M2 money supply, it's coming, guys. Right here, this black thing, it's coming. See how this is starting to come back up? You might see a big move here. And it's not going to be fun. And they're continuing to print money at over a 10% clip. Inflation is probably going to be greater than 10% at some point. I can't tell you the exact timing, but guess what? All we can do is prepare for it. Gold, it's already starting to take off, and silver. You've got your chance right in front of you here. I like platinum, I like silver because of the ratios. Why do I like that? Platinum's the cheapest, probably investable asset that I know in the entire world. The least risk way to play it is through the physical metal, and I'm going to continue to buy the physical metal until it becomes more fairly valued. Uranium's another spot that I think is good because money's going to have to funnel into these 60 companies. I mean, what's absolutely ridiculous with this market is we've got these companies that really don't produce much, Tesla, that are valued greater than all of the other car companies combined. They make some junk products that you can put on your house, these solar panels and whatnot, and they don't. Most of the feedback that I've seen on them has been pretty bad. And they're valued at over $1 trillion market cap. Their daily fluctuations fluctuate more than the entire uranium sector that provides 10% of the world's energy. That is ridiculous. Absolutely ridiculous. Of course we're in a bubble, guys. And crypto, what has crypto done? I'm sorry, guys. The crypto thing, I can't jump on that bandwagon. It's not ready yet. I need a better solution. So if this whole craze, this market bubble starts to pop, I don't know what crypto is going to do. You could see a massive, just complete money exiting that system in its entirety. Now, at some point, if we have problems with energy and we can't grow GDPs and they're growing these money supplies, it means they're growing the debt. It will eventually end in a deflationary collapse. And that's whenever that end is. But usually what they do is they try to inflate their way out of it. So they're going to inflate until it doesn't work. And then if you have some constraint in your energy supply because you can't grow GDP without an exponential use of energy, now you've got a bunch of debt that you can't pay back. That's deflationary. And then people are going to run to something that holds its value. It's not going to be cryptocurrencies, I don't think. I think it's going to be precious metals, but that's me. And they can tax the living poop out of cryptocurrencies. If you're out of the system with precious metals, I think it's going to be much harder to do. And that privacy is going to get a huge premium. So I think what I think is coming is going to be a large physical demand. And what's going to happen when you own an ETF? Everyone's going to try to claim this little chunk of metal that the ETF holds, and they're going to say, we don't have it. Well, you don't own the physical then. So what do you own? A bunch of pieces of paper with a physical representation of it, but you can't get it? What's that worth? Nothing? Sorry, I'm just trying to tell you guys, like, I have thought about this like pretty thorough. And the way that my portfolio is set up is reduce the risk on the mining companies. And the only mining companies I really own a copious amount in, I would say, are, and I'll call it exploration. We've got some exploration, so oil and gas and uranium. Then I own some silver mining companies, but they can be nationalized. They can have problems. And then I got a whole bunch of physical residential real estate, and then like mutual funds and stuff like that, and royalties. So hopefully this wraps your mind kind of around how I'm thinking about things. And you can disagree. That's completely okay. You know, put in the comment section what you guys agree or disagree with. But that's my opinion there. But that's coming. That inflation's coming. If you guys like this clip, give me a thumbs up. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.